If I could ask my first panel, to come up on the stage. And if I may say, a very warm welcome. It's brilliant to see so many brilliant people in the audience. And just to keep on the theme, we have a cracking set of panels for you this afternoon. So approaching the changing world with me, you can see we have Sejal, Neil, Clem and Hannah. And we are going to be touching on some of those political changes that we've just referenced in the opening remarks there, and what part we in international finance centres like Guernsey can play in navigating a path smoothly through that changing world. And I'm going to leap straight into a first question to Neil. It may feel like a century ago, Neil, but only 102 days ago, the UK had a slight change in political guard, with Labour entering government for the first time in 14 years. You've been working with clients to gain a better understanding of the potential changes being introduced and what they might mean. What are clients reporting to you?
Well, I think really the clients can be split into three different groups, but all of them share a really common theme, is they all want certainty. And at the moment, there's just simply no certainty. 2 weeks' time, hopefully we'll have the certainty and some of the answers to many of the questions which are being raised. But when we look at the actual sort of client groups that I'm dealing with, ultra high net worth individuals, perhaps those with the resources and the ability to manage their residence rather easily, then leaving the UK is potentially a very viable option. And the main reasons why they are citing is uncertainty and potential inheritance tax. And in particular, the retrospective inheritance tax applications for trusts. Then we have sort of the lower down, less wealthy non-DOMs. They might have sort of £3 to £10 million already be structured, represent quite a large proportion of their wealth already being held in the structure. And there is genuine concern amongst these clients. They don't necessarily have the resources to simply leave the country, and therefore they are faced with some pretty daunting potential new tax charges. And it's not even a case of simply being able to say, well, we'll just close it all down and take the money out, because typically in these types of structures, there are very, very large inherent liabilities. And then the last group that I'm spending more time speaking to, which I find really surprising, is a huge amount of UK resident and domiciled individuals looking at potentially leaving the UK. Tax is a driver, but not the only driver. It seems to be a general fatigue of the UK and some of the direction of travel. But when you do drill into it, it's very much capital gains tax orientated. Do they leave? Do they realise their business is in a more friendly tax jurisdiction?
Okay, which leads us nicely on to Hannah, because your client group includes a lot of entrepreneurs. We're going to be looking more closely at their specific needs in the second session, but I wanted to ask you about what challenges they're facing, and in that respect, challenges that are perhaps unique to them and different to those of the traditional family models that many of us are used to working with.
Yeah, thanks, Elaine. So yeah, entrepreneurs, I think, are existing in a really challenging time at the moment. There's obviously increasing pace of political and legislative change in the UK and elsewhere, and there's quite a big focus on big businesses as a potential area that's ripe for reform in tax and regulatory spheres. So I think there are a few key challenges that entrepreneurs in particular are focused on at the moment. Firstly, entrepreneurs sort of by their nature have quite a high level of key asset risk. The family's wealth tends to be very highly concentrated around the family business, and that tends to be quite limiting for them in terms of their structuring options, their vulnerability to regime change. For example, something like business property relief from inheritance tax in the UK. Many entrepreneurs are very highly reliant on that, particularly if they're of a certain age. And so they're very vulnerable in that respect. Having a family business or, having a business that they've set up also can be quite limiting in terms of entrepreneurs' international mobility, their ability to restructure, their ability to move abroad, their ability for family members to move abroad, because they're inherently tied to the business and their need to be where the business is. And so I think at the moment, quite a lot of entrepreneurs are quite focused on the sort of limitations that they have surrounding the fact that they are, by their nature, entrepreneurs. The second area, I think, there's a big focus on at the moment for entrepreneurs, or at least when we can get them to focus on it, they should be, is control and succession planning, which is obviously a huge topic. The main challenge, I think, is that entrepreneurs tend to, by their nature, be quite controlling and quite private in terms of how they approach their affairs. And so getting them to focus on this can sometimes be quite difficult. But of course, entrepreneurs who are sort of very passionate about their business, the last thing they actually want is to have a scenario where something happens to them and there's a massive vacuum in terms of control of the business, or they're left with a structure that doesn't work at all in terms of shareholding. And so for getting clients to focus on that can be a big challenge. In terms of what they should actually be doing once you've got them to focus on it, I'm sure that our second panel will be discussing this a lot more. But trusts is still a great option in that scenario. We're still seeing lots of clients looking at trusts as really good ownership structures for their businesses. I think a main reason for this is that it really concentrates ownership of the business in a single shareholder, the trustee, and that sort of cohesion is something that really attracts entrepreneurs, when the alternative could be sort of spreading shareholdings and ownerships across several generations, and that can lead to quite disparate sort of levels of control. I think the final point to note on sort of entrepreneurs and the challenges that they're facing, especially at the moment, is sort of challenges around involving people in the family business and looking to the future. Who should have the rights within the family to be considered to be involved in the business? Who should be automatically involved? What level of oversight should there be on those people? And that's sort of something that works all very well when the entrepreneur's in charge and they're sort of across everything. But as they get a bit older and as they move towards retirement, thinking about passing things on to the next generation and how that's actually going to work can be a real challenge. But yeah, I think it's a challenging time for entrepreneurs, but there are definitely sort of structures and things you can do to help them if you have clients in that scenario.
Sounds really good. Clem, I'm going to turn to you now, please. Because when we're working with families, we often experience family members get different values, different attitudes. Would you say, or what would you say, the overriding difference is between younger and older family members, or is that a lawyer's cliche and there is no overriding difference?
It's a very good question. And I think Edwin has stolen most of my thunder here. Because I think the cliched answer to that would be that ESG is the big difference between the two generations. But actually, I think, in my experience, there's probably been equal engagement between both older and younger generations in that respect. So I think maybe it's better if we flip the question round a little bit and think about the similarities. And in my world, in terms of investment management, normally the similarity is that generations want to preserve and grow in real terms the value of the capital that they entrust to us. That runs across both sides. If I was to really look for a difference, again, I think it's Edwin's point about that international background and the blended families. I think because some of the next gen have been trained internationally, sometimes in financial institutions themselves, there's more of an interest in alternatives, in hedge funds, private equity, private credit, real estate, infrastructure, just because they've got that background, so that becomes more important for them as regards investments. But I think really the key to bridging that gap, and I would say this, wouldn't I, is to make sure you have the right advisors.
Absolutely.
You have advisors with the right skill set, the right experience, the right age profile to be able to engage effectively with all members of the family.
Okay, so you're saying there a lot of it is about the questions that you ask or are being asked. Neil, turning back to the current climate, what are the main questions you're hearing from clients looking to understand their tax position at the moment?
Well, I mean, it's a bit of a case of where to start. So many questions and no answers. The last time I was in this situation was when I tried to help my 15-year-old son with his algebra maths homework, and that went equally as well in providing answers. Originally, most of the questions, vast majority, were all around inheritance tax. That was seen as the absolute key potential change to the non-dom regime, and something which was widely viewed as a deal breaker. And obviously, will it be retrospective? Will it not be retrospective? Then ever since the £22 billion hole was found by Rachel Reeves, which is now today gone up to 40 billion from looking at online, the focus has sort of shifted more towards capital gains tax, with, of course, the main question, what will the rates go up to? And I mean, it's really a case of take your pick, 24, 28, 30, 33. This week we had 39. I think we can most probably expect the higher ECA loans not to be in play, but I think we all expect those rates to go up. And then the other question that I get asked an awful lot is, shall I leave the country? If I leave the country, what will the impact be on my structure? That should always be twinned with another very relevant question of how will my structure be taxed in my new country of residence? Because sometimes it can be very much a pan and fire situation. Yes, if I'm going to leave the UK and go to France, not sure we're going to overly improve the tax take on your structures. But yeah, a lot of questions, all very genuine questions, but questions that can't necessarily be answered at the moment.
Sure. And I'm going to turn to Sejal now, because you've got loads of international clients you're working with on the tax perspective. When they look at the UK, are they looking at the same considerations, different considerations? I know you've had a recent trip that we desperately tasked you about.
Thanks, Elaine. I've always been a believer that don't let the tax tail wag the dog. And I think we are getting into that situation. I recently went to India to launch the India desk for my firm. And it wasn't about tax. It was more about the safety and stability of the UK. Every meeting I went to, they were asking about the riots, about are people getting their watches, their phones stolen or their cars stolen. And that was a concern. And I think it's media portrayal a lot in whichever jurisdiction you're at when it comes to the UK as to what they're seeing. So for anyone, I think they want safety and stability in an economy. And I think this year has been interesting for a lot of jurisdictions, but for the UK, it's been interesting with the change of government, the non-dom rules, which have been around for over 200 years, suddenly getting a shake-up. And there's so much uncertainty. So clients want a home where they feel safe, where they know what's going to happen, where they can prepare for a future. And like Neil said, you know, they're talking about CGT and inheritance tax. It's less so income tax for sure. They're definitely talking about succession planning. And there's so many unknowns. So we've got a 4-year FIG regime potentially, a 10-year IHT tail, but then we've got 3 years for overseas workday relief. We've got temporary non-residence rules, which are 5 years. You know, how is everything going to work? No one knows how they're going to complement or interact with each other.
So how are people managing that lack of certainty just now?
Well, sadly, I think we're all saying the same thing. Wait until the 30th of October and hopefully we'll have some clarity. But at the moment, it's wait and watch.
Yep. I'm going to open that one out to the panel more broadly. And Clem and Hannah, from your point of view, have you anything you want to add on that front?
Oh, well, I was just going to say we've got quite clients have really different attitudes to this sort of stuff. We've got some clients who, are very panicky about particular potential policies that might be introduced, and I think that might be a function of people that they talk to, and they have certain views on how important those things are, and they're doing their own sort of risk assessments of things. But equally, we have other clients who are quite much more relaxed about it and are waiting to see. So it's a real mix, and you really have to have quite in-depth conversations with clients to understand exactly what their particular attitude is to those sorts of risks and what they're doing. So we've got clients who are doing lots of things now in advance of the budget, and we've got clients who are have made that assessment and they're happy just to wait and they want to see what's going to happen first before they do anything drastic.
Okay. And Clem, on the investment space?
Yeah, I'd echo that. And I think it depends on where the family that you're advising is actually from. So if they're international, sort of no change, you just keep going as was. I think for those who have more of a UK connection, there was certainly, I think after March, after the Conservative update to the rules, there was more of this wait and see. People could handle that. Then there was the sense of we really ought to do something, but we were still telling them to just wait and see. And so there's that sort of agitation. So I think there's been an oscillation between, okay, we can handle waiting and seeing, or please let me do something, put in place some sort of a plan B. So I think the 30th will be revealing.
And we all know, of course, a diversified portfolio is absolutely essential to any kind of wealth planning. Right. It feels as though it's a particularly transformational period just now. How can clients mitigate those trans-jurisdictional risks that they're facing in their portfolio? Yeah, I think the question of jurisdictional diversification has been coming up quite a lot in the last sort of decade, for sure. And it does have increasing salience. So I think there are effectively two levels to my answer. The first is structural,
and the second is as regards investment implementation. Structural, I think there are people in this room who are way better qualified to talk about this than me, but I think Sejal's point about structuring not being about tax is absolutely key. And obviously we know that Guernsey is incredibly well placed because it has great people, and the key reasons for having a structure, governance, succession, confidentiality, they remain in place. So I think making sure one is in the appropriate international finance center makes a lot of sense. Also means that in terms of the advisors that you use, they should have international experience. If it's a bank, they should be a global bank with a big balance sheet and so on. That makes a lot of sense too. And I think in investment terms, yeah, I think we all know that you should be diversifying by region, but there's also a huge amount of diversification we also need to implement. So by asset class, by manager style, by underlying investment, and. So diversification matters, but it needs to be done judiciously. And maybe I'll just leave you with a stat, because my firm, Goldman, has been very, very pro the US in investment terms. And if you'd put money into 100 million into the stock market at the bottom of the global financial crisis in 2009, today that would be worth over $1 billion. If you put that money into the Chinese market, it would be worth about 250 million. So getting your regional allocation right from an investment perspective is absolutely critical to those outcomes as regards preserving and growing the value of the capital after inflation.
Brilliant answer. I'd love to hear more.
It's 1%.
Just one, I mean, it is extraordinary, isn't it? Hannah, I want to ask you, because I know we've touched on how great it would be to have put that money in just at the right time, as ever I didn't have it and I couldn't, which is one of those things, isn't it? But you do a lot of work across different jurisdictions, including the US. We know that the UK is not the only jurisdiction experiencing some uncertainty on the tax front. There's a minor matter across the pond going on at present. What can we expect to see in the US looking at the election that's coming up?
Yeah, so the US is obviously facing quite significant uncertainty at the moment. The election's really close. It's sort of historically close. Nobody can call it. It's far too close to call. It does seem unlikely, though, that the Republicans would have control of enough of the legislature to implement some of the more extreme policies that they have discussed. So that might moderate some of what's been reported in the news. I'm an English lawyer, so I don't actually advise on US tax, but we do have lots and lots of US clients who are in the UK or have touch points with the UK who are really, really focused on what's happening at the moment in the US. And we're working lots with those clients to work out what planning they can be doing now, and their US advisors, and to understand what their options are. And it seems as though really a number of the US reforms that have been introduced in recent years have got sunset clauses and pre-programmed statutory expiry dates. So one of the things people are doing a lot is sort of trying to take advantage of those to the extent they can now. So for example, the US estate tax exemption is set to halve from $10 million, which is indexed for inflation, back to a base of $5 million in 2026. And obviously, depending on who wins the election, that may or may not stay the same. So lots of people are kind of rushing to take advantage of those kinds of exemptions where they can. There is very little clear sense of what changes will take place following the election. I think everybody feels that there will be more radical change if the Democrats win. And in particular, I think business-owning families and wealthy families are concerned about Harris's comments about, rolling back Trump's tax cuts for the wealthy, enacting a billionaire minimum tax, the increased tax on stock buybacks, and also increasing the rate of tax on long-term capital gains to 28%, which is potentially a familiar figure in the UK as well. I think from a UK perspective, when thinking about US clients, though, we'll probably still see a steady stream of US clients coming to the UK, because for US clients in the UK isn't really about sort of tax optimization anyway, because US people are exposed to worldwide US tax wherever they live, because the US has a citizenship-based tax system. And so really from a UK perspective, for US clients that we've all got in the UK, the focus will really be on the treaty and making sure that the double tax treaty between the US and the UK works in the way people expect it to, and it can have some quite surprising results. And so I think there'll be an increased focus on that, and US clients will need to make sure they're really well advised on those sorts of issues. So yeah, lots of uncertainty for US people, but I think good quality advice is going to be more important than ever for those.
Clem made the mistake of nodding his head quite a few times there, so I'm going to come to him and ask him for his extra comment.
No, I think that's right. I think, obviously, you work for a firm that is very international. I think that really does matter, especially for these internationally complex families. So I can't underline enough the importance of that broader perspective.
Yeah. Okay. Talking a broader perspective, Sejal, I want to come to you again. With all your international clients, I'm interested in your insights at what the clients are looking at. What are the different approaches? What are they doing in order to protect themselves from this changing world that we have going on about us?
I think they are looking at structures, be it trust, be it even looking to move to other jurisdictions. So I know about a month ago, I had 4 potential clients where I was going to do tax planning and advisory work for them coming to the UK. And then suddenly it's like, let's put it on hold. We'll come back to you Q4, Q1 next year. Because I've been in the position in my career where we set up structures, there was a budget, and boom, we had to unravel everything. And it's a costly exercise. And as advisors, we all want to give the right advice. We can get fees in, but we want to give the right advice and do right by our clients. So it's very much what we've all been saying, the wait and watch game. But if they are looking at other jurisdictions, what are the tax implications there? Because you don't want to go from one to another one. That's going to change so dramatically.
Yeah.
I never thought we would get this dramatic change in non-doms go to a residency-based. If you think the statute of residence test only came in 2013, and now we're going to base all the non-dom rules around residency, it's quite a dramatic change. And I still get clients who are saying, I've been here for over 6 months, I have a home, but I'm not resident because I haven't been here for more than 183 days. And you're like, no, it's the education piece. So we're going to have to unlearn, relearn to advise clients who are happy to go. They can move very quickly to other jurisdictions.
Where are they looking at in terms of other jurisdictions?
So it's funny because I met with someone from Guernsey last week, and they said they've had 3 clients moving to Guernsey now. A lot of my friends are moving to Dubai.
Yeah.
And apologies to anyone going there, but I don't find it culturally fulfilling. But it is getting to that point where you know what you're expecting when you go there. So Dubai, Portugal's another one that people are talking about. Italy, they've got quite a favourable regime. So you get clients, you tell me where I should go. Like, oh wow, the world is your oyster.
I think that's a really key point, is it ultimately has to start with the client and where they want to live.
Yeah.
Because living in a jurisdiction where the tax tail wags the dog is not an enjoyable pastime, really.
Yeah.
We do see people come to the Guernsey for the 5-year temporary non-residence, and then they'll accept the tax charge and go back after 2 years. But I think what people should remember is that there are other options. So we can leave one jurisdiction, stay for a shortened period of time in a friendly jurisdiction from a tax perspective, rearrange one's affairs, and then ultimately end up in the jurisdiction where somebody wants to live, as opposed to somewhere where somebody feels like they should live purely from a tax perspective.
And of course there's that difference between where you're resident and your structuring, basically. And one of the things you touched on when we were prepping for this session, Sejal, was that you're seeing people doing asset and business sales, I think.
Yes, so I know our deal advisory team have been super busy with people just selling businesses. They are happy to pass on assets now. Like we talked about inheritance tax being something that people are worried about. So they are happier to pass on wealth sooner. I think the pandemic really changed the mindset in all of that as well, because suddenly it didn't matter what age or anything you are, you could get caught. So clients started planning a lot more since then, I've seen, from, dare I say, a younger age, even if they're fit and able. So they are passing on wealth and businesses, selling assets, setting up elsewhere. If it's a 10-year IHT tail, then they're happy to leave, move somewhere for 10 years. If that means they're out of UK IHT, which is currently 40%. So there's a lot more mobility. And again, the pandemic made it a lot easier for people to just think, let's go, let's have a better lifestyle, better weather.
Anyone else want to chip in on that?
Only that Guernsey most probably can't offer the weather as the same weather as Dubai. But
More sunshine than Jersey. Spoken hopefully like a true honorary Guern. Neil, just looking now, we've got some extra time, so feel free, all of you, to chip in, but I wanted to come to Neil. Considering all that we've discussed, how beneficial are domiciles like Guernsey in safeguarding wealth now?
Well, I mean, in short, very. And I did have quite a well-scripted answer to this, with everything from robust, well-regulated substance. I mean, all of the buzzwords are in there. James Crawford would be really happy with me from Guernsey Finance for getting them all in. But then I reflected this morning, and I think the best measure is possibly being sat in this room with all of you and being sat on this stage with my co-panelists. Is Guernsey is a quality jurisdiction. We've been in this game for 50 years. We'll be in it hopefully for another 50 years. It's a tried and tested route. When you speak to your clients as advisors, those clients trust you. When you then speak to the service providers that you're going to place your clients' assets with, it's really important that there's a trust there. And that trust is born out of, in my view, the jurisdiction of choice. And to be able to trust in Guernsey as a robust, secure jurisdiction, I think is hugely important. And it doesn't really matter where you sell structures to or where you structure assets from. We spend time in the Middle East and some of our other chosen markets, and Guernsey is a well-known jurisdiction, and it's a very, very well-respected jurisdiction. And that's in large built on the really, really strong legal framework that we have on the island. Anyway, that's a Guernseyman's view, so I'm open to anybody else to
It's okay, I'm smiling, I'm
taint
happy.
my blue sky thinking.
I'm so happy. I'm going to just check, because we've got a few minutes left. Can I come round to all of the panellists then and just check? On that question, in terms of how beneficial are domiciles like Guernsey, and anything else you want to chip in just to round off this topic? I'll start with Clem and then I'll come round.
I think the point I would add to Neil's really good summary of why Guernsey is client service matters. You know, in our business, there's not much you can do to control long investment performance other than things like asset allocation, but you can control your client service. And my experience working with a number of people in this room is that level of responsiveness, the professionalism and so on that matters so much to the family offices and families we look after. It's genuinely at the heart of all of the professionals in here. So I think client service relative to other jurisdictions is very much a selling point.
Brilliant. Seja?
I'm going to say something probably just a bit light-hearted. It helps when I've had clients going to jurisdictions only to come back to say they didn't speak English.
Yeah.
So, you know, it's easy. It's a known. It's familiarity. It's across the seas. And it's a safe haven. You want to be, like I said in the beginning, you want to be feeling safe and stable. So why not?
All those things. And last but definitely not least, if I could come to you.
Yeah, sure. I think I completely agree with all of the points everyone's made about the sort of robustness of Guernsey being really important. But I think in terms of what I've seen advising clients on the kind of legal and structuring side over the course of the years that I've been thinking about these things, I've seen a real shift in terms of, you know, there's a huge amount of scrutiny on clients now, particularly highly wealthy clients. The sort of scrutiny that comes from HMRC inquiries, they're so much more likely to be inquired into, and the amount of sort of reporting that there is with CRS and everything like that. It's just, there's just so much scrutiny on them that they are not willing to risk choosing a jurisdiction for their assets that isn't robust and that doesn't have, you know, real people who are good at their jobs and know what they're doing, sort of looking after their assets for them. It's not really a tick box exercise anymore. It's really important that they have set up a structure somewhere that, you know, they're not going to feel embarrassed when they have to disclose to HMRC that they've got a trust somewhere. And so, yeah, Guernsey's a great choice for that reason.
Well, what a fantastic set of answers with 33 seconds to spare. That's what you call nailing it. Can I ask you to express thanks to our brilliant first panelists? Thank you very much.
Thank you.